welcome to Budget 2013, the Global View, a special show where top global voices lay out their expectations from the Union Budget 2013. May I welcome Russell Napier, veteran macro strategist at CLSA, Rukshat Shroff, who manages more than $5 billion through India-dedicated funds at JP Morgan Asset Management, and Atsi Seth, India Specialist Sovereign Risk Group at Moody's. Thanks very much, all three of you, for taking out the time and speaking with us today. Russell, come to you first. Now, all eyes are on the budget this year, as always. How do you view the event risk around the budget for any market? What does it mean for a market watcher such as yourself?
The important thing about this budget is that whatever step backwards are taken, and there will be some steps backward, every budget before an election has some steps backward in terms of some giveaways, some freebies, some negative impacts on the fiscal deficit. Those are things that we expect wherever we are in the world. The important thing and what rests on this budget is that we see nothing which permanently damages the movement of India to let markets work somewhat better than they have in the past and for the government to back away. So I can't be specific on that because I have no idea what's going to be in this budget. But we can all see, I think most voters can see the obvious giveaways and we can discount those and not worry too much about those. But as long as we see nothing getting in the way of the efficient allocation of capital, a savings system which is beginning to gel to get capital moving to the correct place, those are the crucial things. And as long as nothing gets in the way of that, then the budget shouldn't cause any hiccups.
Rukshat, as an FYI, what do you make of all the noise surrounding the Indian budget? How much can it make or mar sentiment?
I think there are very few countries in the world where people focus on the budget as much as we do in India. So to foreign investors, it's, I don't think, that relevant. And if you look back over the last 6 months, I think to focus all your attention on the budget would be perhaps unfair on the government that has been trying to make a lot of policy changes outside the budget. The last 6 months is evidence that not everything in India happens on the 28th of Feb, right? So we've had a number of reform initiatives, some of them quite tough, some of them quite positive if achieved and if sustained. So I think the budget is far less relevant. I mean, I can't recall what the most important thing in last year's budget was from a foreign investor's perspective, but we invested $25 billion US, the second highest on record, into Indian equities. I don't think it was budget related.
Atsi, now there's talk that the finance minister could surprise with a better than projected deficit number, perhaps even a number of sub 5.3%, that is. How much would you read into such a surprise, given that for FY14 the projected number is 4.8?
I think a surprise on the deficit front would be important symbolically because it would show the government's commitment to the fiscal consolidation effort. However, whether it's 5.1 or even a little bit lower next year, India's central government deficit hovers around 5% of GDP, which from our perspective is a higher level than other countries rated Baa3. So what we're looking for really is not the specific number this year and next, but the policies that can be enacted to move that number materially lower and closer to that of other countries rated Baa3.
Russell, coming to you, do you think this budget would be a reformist budget or a populist one, since this is the government's last opportunity to reinforce its position?
So I pay attention to the long term. So the crucial long-term thing in this budget, particularly as we approach an election, is will the government be overwhelmed by populism, or will it stick to a gradual path of liberalisation and getting the resources of India better allocated, getting the savings better allocated, getting the physical resources better allocated. So anything in the budget which sees a backtracking on that is clearly a negative from my fairly optimistic view on India. We don't expect things to go in leaps and bounds. We don't expect them to go in a straight line. But the opportunity in a budget is to persuade local investors and foreign investors that there's every reason why they should be investing there.
Right, but Rukshat, what are your specific expectations from the budget, especially on taxes from a market standpoint?
Well, if there is some clarity, I think that one of the big challenges for foreign investors is to do with, say, capital gains tax on equities. If there was any clarity or a more benign policy on that front, I would suspect that a large pool of global money that is sitting on the sidelines and has sat on the sidelines waiting to invest in India, to some extent could be catalyzed by a more permanent and a more favorable capital gains policy.
Rukshit, now the CSO expects FY13 growth to come in at 5%. The market is expecting anywhere between 5 to 5.5. What would disappoint you on growth?
I think more importantly, growth is likely to gradually recover. And I emphasize recover and I emphasize gradually because I think a component of growth, which is investment, will take longer to recover than consumption, which is more easily catalyzed by shorter-term changes, such as interest rates. But, we still maintain our view, our medium to long-term view, which is that the sustainable growth rate in India, in real terms, lies between 7 and 8%. 5 and 6 is cyclical. 9 and 10 is also cyclically flattered. So as a result, we think we'll revert back to 7 or 8%. That could take, 2 years or 2.5 years. We're here for the long term. We have been here for a very long period. And we don't get too concerned about the absolute number as long as the trajectory is correct.
Russell, now you're very optimistic about India's macro future. What convinces you so much that India is on the right track?
A whole host of reasons we could go through. The first one we've touched on, which is that the banking system has made some steps towards becoming a robust, healthy private sector banking system. Unlike China, that's crucial going forward. That is the key conduit for taking people's savings and moving them into productive areas of the economy. I think the Indian savings system is also further progressed in other emerging markets in fulfilling that role. That's crucial. Politics as well is generally going in the right direction. It all depends where you start. India starts from a position where the politicians have far too much say in the running of the economy, and it's nice to see that slowly, if annoyingly slowly, going in the right direction. India is not a major export country compared to other emerging markets. I don't see the future for emerging markets being as export-oriented countries, so the changing India or the shocks to India as we go forward with less ability to exports is going to be much, much smaller than it is in other economies. The Reserve Bank of India has very wisely, on the whole, been stepping away from the exchange market. I think that's a very important step in the right direction. Clearly, when there's extreme movements in exchange rates, they do have to do something. But compared to other emerging markets, they're letting it be much more flexible. That, I think, is keeping the economy much more in balance than it does elsewhere. And it certainly played our role in reducing the level of foreign currency indebtedness that India has, which is still at much lower levels to other countries. That's a major, major positive as far as I'm concerned.
Rukshit, now the Finance Minister is confident of keeping the deficit under check for FY13 and FY14. What's your outlook on the deficit front and also targets for the same?
I'd like to make just 2 points on the deficit. Firstly, notwithstanding all the structural impediments that we have, I think there is an element of cyclicality as well. So as the economy starts to grow again, or to accelerate again, we will see the automatic benefits of that to the fiscal deficit because it's a percentage of GDP. That's the first point. Right now we're looking at the deficit, at what we consider to be the bottom of the growth cycle. That's point one. And point two, I think it's, in our opinion, the composition of the deficit is far more important than the absolute number. So, for example, if the deficit was a function of investments that we're making in infrastructure that would add to productivity overall, that would add to efficiency, I think it would be far better than to perhaps spend that, amount of deficit purely in terms of, say, subsidies, which don't even reach necessarily the people who are due those subsidies.
Atsi, do you think a 4.8% target for FY14 is a reasonable target?
So what we're looking for in the budget are really, what is policy going to do with private sector competitiveness and profitability? Because corporate revenues really are a key ingredient of the deficit consolidation process. And on the flip side, what we're looking for is, are the expenditures that can be controlled continually being controlled? We've heard some action on the diesel front, on the fuel subsidy front as well, and that certainly we viewed positively. We look for whether other additional expenditures are going to be curtailed. But really it's the drive towards growth. The bottom line is no growth, no deficit reduction.
Rukshit, now coming to you, what are you expecting from the RBI on rate cuts this year? WPI inflation has come off, but CPI remains stubbornly high still.
Somewhere in the ballpark of 50 to 100 basis points. I guess, the actual answer will be very dependent on the trajectory of inflation. So as inflation eases, we already tackled core inflation, but I think overall consumer level inflation still remains high. So there's adequate room. I'm at the current time, I'm expecting 50 to 100 basis points.
What's your outlook on the currency then for FY14, given the pressure that comes in on account of higher imports there?
The currency, Tanveer, is really linked to global trends in some ways because it has to do with capital flows, whether they're strong or weak. But more importantly, in recent months for India, it has had to do with the import bill and the trade deficit in general. As long as oil prices remain high, as long as gold prices remain high and Indians continue to purchase gold, I think you will see some pressure on the currency from time to time. This can only be really reversed if export growth is kick-started, and this can happen if you, again, to go back to some of the previous points I made, if supply constraints are addressed, if investment is revived, if there's incentives given to revive investment, you'd see that exports in India become more competitive and they are again able to accelerate, especially if the global growth cycle turns around and demand for Indian exports also comes up. So I think the currency will remain under pressure until the trade balance narrows.
Russell, another talking point for India has been the risk of a potential downgrade. Post the recent measures and the finance minister's efforts to boost investor sentiment, do you think that risk has receded?
Okay, India will be in a better position than just about every other emerging market. When we look at this combination, we have to look at the total amount of foreign currency debt and the current situation of the balance of payments. And the one thing that sets India apart is that foreign currency debt is probably less than 20% of GDP. Certainly based on official sources, it's less than 20% of GDP. That is right at the very low end for emerging markets. So when a balance of payments crisis comes, historically that's a level at which any country can sustain payments on its foreign currency debt. There are no issues of significant credit quality and the country remains solvent. Most emerging market countries are through the 30% level, and that's a level which we historically associate with credit events. So whatever happens to India in terms of a credit downgrade, it should be minimal compared to the credit downgrades we can expect across emerging markets. So once again, everything is relative. So I think the rating agencies should really take that into account, and whatever happens in terms of their view on India, it should be much more lenient than it is on many other emerging markets.
I'd say, how would you respond to that? Don't you think rating agencies are being a bit unfair to India?
But remember that rating agencies don't answer the question, what is the growth outlook going to be, or how is India going to perform vis-a-vis other countries just on growth? The question we answer is about creditworthiness. So what is going to be the sovereign's, which is the government's ability to repay its debt, given the very, very facilitative growth outlook? And here, India does not compare well to its peers. India's fiscal deficits tend to be far higher than most emerging markets. India's government debt ratio is far higher than most emerging markets. And this is something that is a concern for rating agencies. This is essentially what we are rating, the government's ability to pay back its debt. The higher it is, the government's interest payments to revenue ratio is about 20 to 25%. For many countries, it's about 9 to 10% in a similar rating scale. So these are some of the issues that we look at, not just growth.
I'd say Moody's has retained its rating on India at Baa3, which is investment grade with stable outlook. With the recent roadshows conducted by the finance minister assuring investors about the India story, has the risk of a potential downgrade receded? And over FY14, with growth picking up, could one expect an improvement in ratings?
I'm glad you asked that question, Tanveer. So as you said before, our rating outlook is stable on the Baa3 rating, and we maintain the stable outlook over the time that growth started decelerating. And one of the reasons we maintained it stable and didn't take it to negative is because we felt that the growth deceleration was actually temporary. It was partly cyclical. It was partly driven by external factors. And we did think that any policy effort or any pickup in global growth would actually drive growth slowly up. And that, I think, is still our base case. So given that our base case is coming through, our stable outlook really is maintained. If growth picks up, as we expected when we kept the stable outlook, it wouldn't change our stable outlook. And what the stable outlook basically has meant for us is that the likelihood of either an upgrade or a downgrade in the next 12 to 18 months is low.
Russell, now coming down to talking about the markets, you still find India expensive on a cyclically adjusted price to earnings. What's your outlook on the Indian market?
At 22.5 times, which is roughly where India is, historically there are very few economies in the world which produced both the discount rate and the growth rate to vindicate that. Now, why I think it's coming down, and it is worth stressing that all emerging markets have similarly high, or nearly all emerging markets have similarly high cyclically adjusted PEs. But the reason I think it's coming down is because of balance of payments crisis. If we look at the history of EM, that's what happens. We have lower growth expectations dramatically. We even have, for more leveraged countries, some solvency issues, and suddenly valuations fall. So I'm often meeting people who tell me that, well, India will never trade at that sort of valuation, EM will never trade at that valuation, but emerging markets, or Asian emerging markets, traded at that valuation, low cyclically adjusted PEs, down towards 10 times in 2003 when we had the SARS crisis, and also in 1998 when we had the Asian economic crisis.
Yeah, Russell, but many would believe that a 50% fall from 22 times to 15 times or even lower is unthinkable. What would you say to them?
So the problem with deflation when it comes, and it's not a new thing, we've seen it, we saw it in the Asian crisis, we saw it in 2000, we saw it once again post-Lehman Brothers, and you have magnitudes of declines in equities, 30-40%, and in some emerging markets much more. So we've actually witnessed it happening in EM fairly regularly over the past 2 decades. So not only is it possible, it's been observed, and anything that's been observed I think is probably possible going forward.
Rakshit, what's your view on India from a value versus growth perspective? On the back of a fantastic 2012, could we see more upside for the market?
I think it's fair to say that we at JP Morgan Asset Management, we've historically had a very supportive and constructive view on India. I think, if you break it down into 3 sources, earnings, valuations, and again, from our standpoint, currency, I'll try and, look at that individually. So, the expectation on earnings is that growth in the next fiscal year will be, let's say, about mid-teens, 14-15%. I think that's a broadly reasonable estimate at this point. So that's a positive backdrop, which will mean that earnings are accelerating over fiscal 13's single-digit number of 7-8%. So that's positive. Valuations at the moment are middling, right in the middle of the long-term average. We think that the currency is at the moment anywhere between 2 to 5% undervalued. If the fundamentals of the currency start to improve, which means if there's any easing up in the current account deficit, dollar returns could be higher. So, some sort of mid to high teens is a reasonable expectations. And valuations will change based on flows, domestic as well as foreign flows. Obviously, this will all be punctuated, as you said, by elections. But again, I think that's a source of volatility rather than a disruption of the Indian investment case.
Russell, you've also highlighted that there's very little correlation between the Indian macro story and its equity markets. Why is that? Aren't markets a lead indicator of macro health?
So it's statistically proven that they don't link up. As I said, how do you make money out of buying equities? Actually, it's fairly easy. You buy them when they're cheap and you sell them when they're expensive. And that may or may not coincide with positive or negative macro, but they don't. But statistically, there's no lead indicator from one to the other. So there's just no relationship there. It's more an issue of value. My job, top down, is to say, is it expensive or cheap, and then what are the forces that will bring it down and make it cheap, when that will happen, and how long you're going to have to wait. So I think it's because we've seen such a dramatic deterioration in EM balance of payments that it tells me that it probably isn't going to be too long before we get an opportunity to buy them cheap. But yeah, one of the greatest pieces of mythology in our business is there's a link between the macro and and your total returns from equities, and it's just not true.
Now, the price of oil, which is very important for India's import bill, what is the expectation from oil prices going forward?
I mean, I've got a very negative view on oil prices. I think it will come down. It's one of the reasons why, for all the problems India has and for all the problems all emerging markets have, India's in a better place than many, because it is a major beneficiary of lower commodity prices. And we have to remember that for many emerging markets, they're net exporters of commodity prices. So for all the problems that emerging markets face going forward, India will be importing cheaper products going forward. That's because I believe that we'll see a scramble to pay back dollar debt this year. We'll see a sharper higher dollar, sharply lower growth expectations for emerging markets, and therefore sharply lower oil prices.
Rakshit, as a money manager, where is your sector preference as far as investment is concerned in India?
I think, we still remain invested. We are overweight in the financial services space. We still remain overweight cement, which is proving to be an attractive opportunity because some of these stocks have corrected recently. I think within consumption also, we're seeing some attractive opportunities. As you know, I'm not willing to name individual stocks, but I think within those sectors, and even to some extent within the domestic cyclicals, there's a fair bit of value available for the more patient investor.
What could surprise you or disappoint you in Budget 2013?
Given that the consensus is that growth is going to be closer to 6% than 7%, similar assumptions would obviously make sense. On inflation, I think that there is a sense that while it's abating, it has not been completely vanquished. So we would look again for inflation numbers around 6 to 7%. And of course, what matters for budgetary targets is the combination of growth and inflation, which comes to about 12-13% of the nominal growth, which is real growth plus inflation. So that, I think, is something that will probably underpin the assumptions for FY14. But really what would impress or would puzzle us would be the way that growth is presumed to be revived. We've seen in the past that too often macroeconomic policy efforts towards growth focus on demand-side measures. So they try to revive growth by fueling demand. What happens when you fuel demand is, yes, growth does revive, but so does inflation. And then inflation very quickly puts the brakes on growth as well. So what I think would be really facilitative for the entire growth effort and for a more medium-term sustainable growth effort is supply-side efforts. And I think to your question about what would be impressive would be more effort towards the supply side in India.
Well, thanks very much, Russell, Rukshad, as well as Atsi, for joining us and giving us your perspective on Budget 2013. With that, we come to the end of this very special show. Thanks very much to all our viewers for tuning in.